Hello, everyone. I welcome you all to my YouTube channel again. Thank you for being part of it. Today, we're looking at a particular course in accounting. It is titled Introduction to Financial Accounting, and the course code is ACC 111. ACC 111 is a course in Department of Accounting, University of Lagos, meant for year 100 level accounting students. Today we're looking at adjustment to trial balance, and we're looking at the first part of the topic. My name is Obafemi Oyewumi. Thank you for being part of it once again. Um, Learning objectives, we're talking about timing issues in accounting, accounting concept that necessitate adjustments, recognition of revenues and expenses in accounting, adjustment to trial balance, types of adjustment in accounting, account adjustment for accruals, for deferrals, and other items in um, accounting. Now, let's look at the basis of accounting. There are two major bases of accounting, that is cash and accrual basis. The cash basis talks about recognition of transactions based on cash payment and cash receipt. Okay, this usually is not applicable to business organizations, business entities. The second one is accrual basis. Accrual basis of accounting talks about revenue and expenses, being recognized, in accounting according to the period that they relate to. Okay, that's accrual basis. Now, there are three major concepts that are related to this particular topic, talking about adjustment to trial balance. The first one is going concern, the second one is periodicity, and then the third one is matching concept. When we talk about going concern, we're saying that whenever a particular company begins operation or entity begins operation, it is meant to be in perpetuity. The periodicity says that, oh, despite the fact that a particular company operates in perpetuity, there must be a periodic reporting of accounts. Okay, and then the next one says, talks about matching concept. So matching concept says, okay, since you're going to break the a perpetual nature of the company into periods, then you must match the revenues and the expenses, related to each period appropriately in order for you to be able to report, the profitability of the entity, as at when due. Now, what does it mean when we talk about adjustment to trial balance? These are adjustments made to reported account balances in the trial balance, which result from the provision of additional information on the true values of those balances. We're saying here that adjustments to trial balance are an attempt made to reflect the correct balances, which would have been different if all information had been made known as at the end of the year. So, at a time that trial balances are being drawn, or balance are being drawn from the different accounts to make up the trial balance, some information is not made available, and so at the end of the day, when the information is made available, then you have to go back to change, and adjust some of the balances that are already extracted from the different accounts, and consequently those adjustments are made through the general journals at the end of the accounting year. Types of adjustment, I categorize them into three. The first one is accruals, the second one is deferrals, and the third one, other adjustment. For accruals, we have accrued revenues and accrued expenses. Deferrals, we have unearned revenues and prepaid expenses. For other adjustment, bad debts and depreciation. Now, for the purpose of this part, we'll be looking at the first two, accruals and deferrals. The next one will be taken in the next part. Okay, now adjusting for accrued revenues. I've tried to make to define revenues here according to IAS 18. Okay, and also talk about expenses as well. Revenue is the gross inflow of economic benefit to an entity during a period resulting from the ordinary activities of the entity. Okay, then of course it could come from sale of goods, rendering of services, and then income from interest, dividends, and royalty. An expense is an expenditure or cost incurred in a course and for the purpose of generating the revenue of an entity in a particular period. According to matching concept, these two elements are combined together in order for the profitability of the company to be known, for a particular or given period. Now let's talk about adjustment for accruals. So we're looking at accruals now. You have two, like I said, accrued revenues and accrued expenses. So when we talk about accrued revenues, what do we mean? These are revenues that have been earned but yet to translate into an inflow. So it's possible for you to collect money, okay, on behalf of the company, but the money that you collected is not related, rather this one talks about revenue that have been earned but yet to be translate into a cash inflow. What this means that yes, you made sales, but money has not come in. Physical cash has not come in, and notwithstanding, you still have to, recognize the income, notwithstanding the fact that you have not received, the cash at that particular point in time. We have an illustration here, and we said that Mr. Bodmans, a tenant with XYZ Limited, could not afford to pay his rent of 600,000 for 2 years on the due date of April 1st, 2019 until January 2nd, 2020. How should this be treated in the books of account as at December 2019? How should it be treated? Remember 600,000 for 2 years. The due date should have been April 1st, 2019, but the money did not come in, as at 20 until 2020, January 2nd. So how should it be treated? Now consider the amount first. The total amount is 600,000 for 2 years. That's 24 months. So let's look at the amount to be that is due to be recognized as rent income for each month. So that's 600 divided by 24. Okay, so amount to be recognized in 2019. Remember, this money is not coming until 2020, but you still have to recognize a portion of the total amount in 2019. That's what we're talking about, accrued, revenues. All right, so that will be 25,000 multiplied by 9, and that will give you 225,000 naira. So let's look at our accounts here. We have the rent income account, and then we have an account for Mr. Bodmans. Okay, now what are we saying here? The rent account, despite the fact that you're not collected cash, must still have an amount to be recognized. So 225,000 is debited to Mr. Bodmans, okay, and then it's also recognized the debit, the credit goes to rent income account. All right, so at the end of the day, it's showing that Mr. Bodmans, is actually owing 225,000 naira, whereas in the rent income account now, the balance is transferred to income statement as a revenue for that particular period. Now let's go to the second aspect of accruals. That's accrued expenses. Accrued expenses. When we talk about accrued expenses, we're talking about expenses already incurred, but for which money has not been paid out, that has not been cash outlay for that particular expense. So it's possible for you to have incurred an expense, but you're not physically giving out the money. For example, we talk about insurance. In some cases, it could also come in form of rent. In some other cases, it could also come in form of periodic expenses which one has not been able to make payment for, the company and the entity. So we're saying that in order to fulfill matching concept principle, which entails that all expenses, whether paid for or not, should be squared up against the revenue earned for that same period. When an expense is incurred, it must be recognized in the income statement, even if it has not been paid for. Now, let's look at the following illustration. At the end of the year 2020, XYZ Limited received an electricity bill for the sum of 120,355 naira as electricity charges for December 2020 from Discos Electric Limited. During the year, the company had paid the sum of 650,450 naira. How much will be treated as electricity charge in 2020? Now, remember, this company had already paid 650,450. Now, that was the amount recognized in the trial balance. But somehow a bill came, probably in January 2021 to say that, oh, the bill for December, you did not get it that time. This is the period now that the bill had just, come in. So what should you do? For you to know the total amount of money to recognize, okay, in your electricity charge or electricity bill or electricity expense, what do you have to do? Calculate the amount paid to date, which has been given in the trial balance, add to it the bill for the month of December. That's what we've done here. So amount paid today 650,450, and then bill for December 2020 120 355. Add the two together, and that will give you 770,355. So that is the total amount of money to be recognized. That's 770,805 to be recognized for the year. So that means there must be an adjustment of 120, to be added to the amount already paid. Okay, that's a particular example here, but of course I want you to solve this as much as possible on your own, and of course hit the chat or the comment box to give the answer there. ABC Limited experienced a major setback toward the end of December 2020, which prevented her from paying salaries to staff for the same month. The total amount involved was 5,450,000. How would this be reflected in the accounts? Please answer in the chat or comment box. I'll see it later on. Now, adjusting for deferrals. Now we have two categories as well. The first one is unearned revenue. Okay, unearned revenue. What does this mean? This is referred to as income collected in advance or deferred income. Okay, in effect, the recognition of the income is pushed forward until the ownership is transferred or sale of good or rendering of service is consummated. What we're saying that it's possible for you to have received cash into the system, for the entity to have received cash to the system, but of course the revenue has not been consummated because there has been no sale of goods. Okay, there has been no rendering of service, and the ownership has not been transferred to the person that gave you the money or the client that gave you the money. So it means that you cannot take the entire amount of money and take it to your income account. You have to defer the portion that's yet to be earned, by you as an entity. Now let's look at the example that we took earlier on. Consider our initial example, and let's now assume that Mr. Bodmus paid his rent of 600,000 for 2 years on June 1, 2019. Please take note of this date now, June 1, 2019. How should this transaction be treated in the books of accounts as at December 31, 2019? Remember our example then, okay, of this particular person, Mr. Bodmas. Mr. Bodmas, a tenant, okay, should have paid 600,000. Then in April, he didn't pay until January 2020. Now we're looking at another variant of that particular case. They're saying that this man paid for 2 years on June 1, 2019. How should this transaction be treated, or what would be the amount to be recognized in the for the entity as revenue? Now let's look at the answer here, okay, or the solution. Remember, we have to calculate the rent payable per month. How much? 600 divided by 24, and that will give you 25. Remember, we did that earlier on. So calculate the expired portion, the month, in question. And we talk about 7 months, okay, and we said that you have to multiply the expired period by the monthly rent, and that gives us 25,000 times 7, which is 175,000. Now let's see how it's been reflected, in the accounts, for that same period. Remember, we're looking at 2019. He paid 600,000 naira on June 1st, 2019. Now, should the entire amount of money be taken as income for the year 2019? That's the question. Okay, that's the question. Now, let's look at our rent account and let's look at our rent in advance. Now, when this money was paid by Mr. Bodmans, 600,000. So the 600,000 came in, all right. So the debit must have gone into either cash or bank account. So we have the credit, coming into rent in advance. Okay, rent in advance. Now, let's look at the amounts that should have been that expired in 2019. The total amount of money was actually 175,000. So meaning that 175,000 is taken out of rent in advance, okay, by a debit entry, and then the credits went into rent income account, okay, and it's reflecting the account where the money came from, 175,000. So the credits went to rent income account. So at the end of the period, 2019 December 31, this amount is taken to um, um, the income statement as revenue for that period, meaning that there's a balancing figure, that we must account for, 425. 425 now becomes unearned income, which has now been taken as balance brought down of 425. What does that mean? What this means is that 600,000 received. Out of this amount, 175,000 was recognized in 2019, and the balance of 425, was deferred, to be recognized in the year 2020 and the years ahead. All right, so that talks about unearned income. Let's look at the other one, which is prepaid expenses. Prepaid expenses. When we talk about prepaid expenses, we are talking about payments made for a service. Okay, payment made for a service that you have not enjoyed the benefit of. Okay, a service that the company or the entity has not enjoyed the benefit of, and that means that you also, because of matching consider to push, have to defer, the recognition of such an expense until you enjoy the benefit of that particular payment. Now, when the payments for a period expense, spans beyond an accounting period, there is need for it to be expended, okay, for its expended portion to be recognized according to the year that is related. Okay, in other words, the expired portion will be expensed in each year, and the balance will be carried forward as prepayment. Illustration: XYZ had the sum of 1 million at the beginning of year 2018 as prepaid rent, mark you, prepaid rent, and later paid another sum of 4 million for the same rent on July 1st, 2018 for 2 years commencing July 1, 2018. It's important that you take note of this date and this period. Now, make necessary entries in the book of the entity up to the year end December 2018. Okay, now let's look at the solution here. Calculate rent payable per month. That's 4 million divided by 24. That's for 2 years. So we have 166,666 naira, 67 kobo. Okay, for how many months? 6 months. Remember, it was paid on the first day of July 2018 for 6 months. So we have 6 months as the expired period. So calculate the expired amount. How much? It should be 166,666 naira, 67 kobo multiplied by 6, and that will give you approximately 1 million naira. Approximately 1 million naira. Now let's look at the accounts. All right. So for the amount paid by the entity, it was paid on first day of July 2018. So money will leave the bank. So there will be a credit to the bank account, and then a debit came into rent prepaid account. Look at it here, rent prepaid account. Then don't forget that there was a balance brought forward for rent prepaid. How much? 1 million on the first day of 1st of January 2018. Balance brought forward was 1 million. An amount of 4 million was paid on this particular date. Now, it means that 1 million that was brought forward expired before the commencement of the new tenure. So, while 1 million will be credited to the rent prepaid account and debited to rent account as an expense. Okay, then subsequently again, the out of the 4 million, remember what we calculated here, out of the 4 million, 6 months expired in the year 2018. So we're going to take 1 million by crediting it to the rent prepaid account again and debiting it to rent account. So at the end of the day, you have a balancing amount figure here of 3 million. So this balancing figure of 3 million will be debited again as balance brought forward, balance brought down in this account. So it is now 3 million here. So this is an asset to the company. Okay, it is a current asset to the company, rent prepaid. Okay, so here come back to rent. We have the first 1 million that expired on the 30th of June, should be 30th of June 2018, and then the amount that expired in 2018, the first 6 months. Okay, so we have 1 million there, and the total amount now becomes 2 million, and this amount will be taken to the income statement as an expense, for the period, meaning that you defer, 3 million to subsequent years, whereas 2 million was the amount recognized or should be recognized in the year 2018. So that brings us to the end of this particular first part of the class, of the lecture, talking about adjustment to trial balance. We're saying that there will be need for trial balance to be adjusted, that's balances from the different accounts to be adjusted, because some information, would have come in as at the end of the year that was not known when the trial balances were when trial balance was extracted, earlier on. So there is need for an adjustment to be made, and we have identified the different types of adjustment. We'll talk about the first category as accruals, and then the second one as deferrals. The next one, which is order adjustment, will be discussed in the next lecture. I want to believe that you have learned one or two things in this particular topic, even as we bring this particular class, this particular lecture to a close. Don't forget to subscribe to this my YouTube channel, so that you'll be able to get alerts when I post other videos here. Okay, it's important that you subscribe, you like, and of course you share as well. Thank you very much for being part of the class. If you have any questions or any comment, please don't forget, you can just put it in the comment box, and I will see it and I will respond appropriately. Thank you very much. God bless you.